Hey, this is Alan Corey, always otherwise known as AC. And you can Google the House of AC and learn a lot about air conditioners and nothing about me. But you can go to at the House of AC on any social media channel, and you get to see my pretty face 3 times a day, pretty much, depending on what channel that you pick. So lucky you guys, free AC face on online. The beauty of the internet. What a fun time to live in. Today we are talking with Jasmine Team's branch manager Jeff Goddard. He's going to go over a lot of questions that buyers have post closing. Obviously there's a lot of questions going into purchasing a house. How to get a mortgage, a home inspection, what's escrow, what's earnest money, what's closing date, moving guys, all that stuff happens up front. And then things kind of go quiet a lot of times post closing, and you're left to your own devices. Not if you do a deal with me, but that's once you do a deal with me, you never stop hearing from me. I want to stay in touch. I want to know what's going on, but it's quieter, right? Because there's not a time pressure, there's not a time crunch. And then things happen. Things start showing up in your mailbox post closing. They are things like, spam mail that says, if you want a copy of your deed, send us $500. And it looks like very formal and like a legit thing that you need to do. And I get a bunch of phone calls about this. And, sometimes it's $50, sometimes it's $75. And a lot of people buy it. Hey, of course I want the deed to my house. Let me pay for it. Well, here's the deal, guys. It's free. One, you don't need it because it's been recorded on a government office and it's free. Your closing attorney also has it too. It'll show up in your mail box for free 3 months later. But if you want one today, and a company will gladly print it out for you and mail it to you for $50, $75. So you're going to get those solicitations. Occasionally, actually quite frequently, you at one point will get mail that says, hey, guess what? I know you closed your loan with mortgage company A, but it's been sold to mortgage company B. And then you're questioning whether is this a spam or not. Typically it's not. This happens. And so we're going to bring in Jeff Goddard today to talk about why this happens, what this means for you post-closing, and all your mortgage related questions post-closing and what you can do about it. Are these legitimate worries? And does this mean your mortgage payment's going to change? If so, how can I prevent it? All these things that you may not think about till after you own a property, or that you've owned a property and these things sort of kicked in. So let's get to it, and let's bring in Jeff from the waiting room into the studio. Hey, Jeff, thanks for joining us.
Thanks for having me. How is everyone doing?
Well, everyone, I assume, is doing great, because I'm not getting comments about like, I can't hear you, which I get a lot because I forget to turn my mic on. Depending on if you're a fan or not, maybe you don't want to hear me and you prefer my show is better on mute. You never know where things are going to go. Jeff, explain a little bit what you do with Jasmine Mortgage Team for us.
I think branch manager and master of the boring stuff is my title.
That's right. It is on your email signature, master of the boring stuff, everything to do with mortgages. So so
basically I work with real estate agents all the time, and I deal all the financial stuff and payroll and all the boring parts of the mortgage world. It's more fun to talk to agents and clients during a transaction and all that. And I do a little bit of that, but most of it's behind the scenes.
Cool. Yeah. And so, and real estate investors as well. I know they have a lot of questions because they're buying a lot of properties. And so you sort of learn by trial by fire here. You do, and then you figure it out, and then you don't make the same mistake next time, or you do the same thing that you accidentally did that worked out financially for you. So first things first, I get a mortgage with jasmineteam.com, Jasmine Mortgage Team. For example, and great experience. I want to give you my business. We've done personally 15 or so deals together, my own deals, my own refinances, everything like that. why does it, a year or two later, sometimes I get in the mailbox, hey, now Rocket Mortgage is managing your loan, or hey, your loan's been sold to Freedom Mortgage, or some of these other companies that I've no relationship with. I've never heard of them. I've never sent my information to, and now my mortgage payment has to be paid to them. Can you kind of walk me through that process?
Yeah, absolutely. So what's going on in those situations is that the servicing of the mortgage is changing. Servicing means where you send your payment, who calculates the remaining balance, who updates the balance if you send in an extra principal payment, who tracks that the insurance and the taxes are paid, and that the escrow account is fully funded most of the time. And we'll talk about what happens when it's not fully funded, but that takes effort. They're spending money to send out statements, and sometimes they'll go paperless, but they're getting paid the same amount. But a lot of people would prefer that for a couple of different reasons. But so the thing most people say is, well, why the heck did my mortgage get sold? Like, that just feels like bait and switch. The good thing for consumers is that the investors that buy mortgages, just like all other financial entities, need to have liquidity. They need to know that they can move assets around if they need to. And sometimes that means buying a bunch of mortgages or a servicing portfolio of mortgages that you're going to manage. And then sometimes you don't want to have that. Maybe you want a higher risk project that you want to invest in as a bank or something like that. So people will want to or not want to sell their servicing portfolio. The thing for the consumer is, yes, it is a different customer service team that you're being moved to, but none of the terms of the loan can ever change. So that if you have questions about it, please feel free to reach out to us. We can help you determine some of Alan's things like, hey, is this legit or is this spam mail? But it's very common. And here's the good part about all of that. If mortgages weren't sold after the closing, we would have much higher interest rates, because the investors that invest in the mortgages, the money has to come from somewhere. They don't necessarily want to hold this debt for 30 years if the person never refinances or sells at 3.5% when the rates are now at 15 or whatever they're going to be in the future. So it really, having that flexibility means that consumers get the lowest rates possible.
Okay, so let's step back a little bit here. I know that I guess it falls under the category of real estate investing, but it's called note investing. And this is tangential. Man, I always say words I don't know how to pronounce. I whatever that affliction
I'll help
is.
you with tangential. Yeah,
Tangential. Thank you. And so related. I've looked into this a little bit. So if I am an investor, I want to buy a note investing. A note is also another name for a mortgage. And so basically what someone can do is say, hey, I want to buy a seller note. And so what a seller note is, a mortgage that basically the seller is the lender. So there's a lot of different scenarios here, and I hope I'm not confusing people, but I want to sort of set the stage on how to approach this, either as a real estate investor and then also as the mortgage side. So I could go say there's a house down there's websites to buy and purchase note investing. And so what I could do is say, I want to buy this guy's mortgage. It's a mortgage on a house, $300,000 mortgage. And the person selling that mortgage, typically they don't sell it to you for $300,000. They'll sell it to you for $200,000, right? They sell it. So you can buy it. It's a lot of times 75 cents on the dollar, 30 cents on the dollar. And the reason for that is, if you own a mortgage, you're getting slow payments over time, 15, 30 years, 15-year fixed, 30-year fixed, or maybe you're buying a mortgage that has 22 years left on it. And you're slowly getting that money trickling in. But if I own a mortgage, I could make a lot of money by saying, well, let me sell this at 75 cents of the dollar, and then I get a big windfall today and I can move forward. Sort of the cons of note investing for those interested is, the difference between that and actually buying a house and getting a mortgage is typically the value of the home goes up and it'll appreciate in value. and a mortgage by its definition is going to always go down in value as the principal gets paid down. It's worth less as you go, and you get a little stream of income for that. Some people like to buy in this space mortgages that are almost in default or falling apart. And so sort of the carrot at the end of the stick is, hey, I can get this person to refinance and maybe get in a better rate mortgage. So maybe they're having trouble at a 7% interest rate, and I can get them in a longer mortgage at 5% to save the deal. Or maybe we can work out a way where they exit quietly and I get to acquire a property at a discount. There's different ways to look at note investing. And I know you're not doing any of that. You're doing it less on the real estate investor side, even though you do some real estate investing mortgages, but you're doing it almost at scale. Hey, we sell 50 mortgages this month, and not you specifically, but your company packages them together and then sells this to an institution, a bigger bank that sort of, like you said, they need to balance their portfolio and have some more long-term debt, or they need to disperse some cash and they want to buy more. And what happens, from what I can tell, is when my loans have been required, a lot of times they like to buy into things that, maybe 3 years ago, I've got a 4% interest rate, and now they've acquired a customer from me, and they try to sell me a new product. They want me to refinance at 3.5%, sort of situation. So that's why people want to buy mortgages. They're buying customers in some regard. But now that I've sort of laid that out, can you say it again, why this is good for consumers? Why does this make it this cheaper for me to get a mortgage? Because
here's the deal. If normal people were always the ones loaning the money for others to buy houses, for example, me and you, Alan, we want to start a mortgage company.
Yeah.
We pool together $1 million, and 4 people walk into our office the first day, and each of them wants a $250,000 mortgage. A month later, when all those close, we don't have any more money. We're sitting back earning 3.5%. That is not how I would invest $1 million.
Right.
So why in the world does anybody loan people hundreds of thousands of dollars with very little down payment sometimes at crazy low interest rates? It's just like a retail model. You buy shoes in the shoe store, you buy low, you sell high. That is the margin in between them. And so if what we did with those 4 notes that we closed in our mortgage company that month, if we did do that and we wanted our money back, we could sell them to somebody that wants that stream of payments. And that would be an investor. Now, we don't really want to just have that kind of, if we were doing that, we could turn our inventory. We could maybe do 10 million a month with our 1 million in capital because we turned our inventory 10 times.
Right.
And so that's independent mortgage banking kind of 101. So, but again, why would you? So it's the fees that happen when you do that cause us to get such good rates. Now, if you and I really wanted to invest $1 million as mortgages, what rate would we charge if we might have to hold it for 30 years? 15%?
Right. That's like a hard money loan, private lending. Right.
Yeah. That's why those loans are so expensive. They can't sell the loan and get their money back and do it over. So that whole idea of liquidity in the market to be able to move the loans, 90% of what we do at Jasmine Mortgage Team is sell directly to Fannie Mae and Freddie Mac. That's the vast majority of what we do. We could sell to Chase or Wells Fargo or one of those. And because of the way we originate it, if Chase buys $1 billion in mortgages today, they didn't originate, they could sell them to Fannie Mae tomorrow as long as they originated in a way to do that. So Chase is liquid. They could do it. But typically, the easiest, best option is to go straight to Fannie Mae or Freddie Mac. Now, here's the deal. Fannie Mae and Freddie Mac do not service mortgages. They hire servicers to service their portfolio. So let's say we sell a loan straight to Fannie Mae. You may end up with Mr. Cooper as a servicer. Or Waterstone could choose, hey, you know what? We're going to keep these. We're gonna make a little bit of money every month servicing them. And that might make sense for our business right now. Or we go ahead and let that servicing go. So that liquidity that transferring servicing and selling the mortgage offers is what keeps interest rates low. So what happens is you have a big entity that now here, maybe a big financial group wants to invest in an oil well in a very risky location. they need $500 million to go in on it.
Yeah.
It's super high risk, but if it hits, they're going to be gajillionaires, right? So instead of doing something that risky, they maybe, instead of that 500 million just being all they do another 1.5 billion in something really stable and safe, like mortgage-backed securities. And they don't mind if that doesn't pay a whole lot. They're just offsetting the risk of this other great venture they're doing. So normal people typically don't want super low return on their hard-earned cash they're investing. They're gonna need something more tangible. They're not having to offset and like formulate the balance of this portfolio all the time.
Okay, got it. So, because you are doing the hard work of acquiring the customer, underwriting them, getting them down in a very low interest rate, and then you're able to resell that loan to someone else, so that you now free up funds so you can go give a mortgage to another new person at low interest rates. That buyer, do they have the right to change the mortgage terms or anything along those lines?
No, absolutely not. So, any time a residential mortgage gets sold, it is in America. There's going to be the same terms, or there's going to be a law being broken. I mean, it just can't happen.
Okay, so you've already signed a contract saying this is the terms of my mortgage, this is my interest rate, this is the years, this is how much you're going to pay each month, and it doesn't matter who the servicer. It could be you to start, it could be Mr. Cooper or something. The servicing company is the one collecting the payments and sending out the statements and all that. But this has happened to me where my payments have adjusted post closing. They have gone up.
Oh yeah. Well, this brings us to a next question, right?
Right.
You want me to say the
Why
question?
does that happen? Yeah.
I hear this all the time. I thought I had a fixed mortgage. Why did my payment just go up?
Right.
Well, the part on a fixed rate, like a 30-year fix, for example, the most common, the fixed part is the principal and interest payment that's amortized over 30 years. And that's the majority of the payment. And that's good that that's fixed, especially in a low rate environment where they're probably going to start rising even more. Lock in now. So the part that isn't fixed, and if you don't put at least 20% down, you don't have an option about whether or not to include your escrow payments for taxes and insurance in your payment. If you're under 20% down, you have to include taxes and insurance. Now, here's the thing. Taxes and insurance change every year, but just like everything else, you don't know for sure how much that bill is going to be until you get the bill. So the servicer and the lender setting it up front are going to do their best to anticipate. For example, one of my personal mortgages, they didn't even wait until the new tax bill came out for Atlanta. They said, hey, this property is appreciating rapidly. We anticipate your bill is going to be higher. We don't want to surprise you like crazy in October because you've underpaid so much. So go ahead and start paying more today. Now, most of the time that doesn't happen. Most of the time, if the client is surprised, the servicer was also surprised. They didn't think taxes were going to jump a whole bunch. Other times when you see that happen is when the tax bill is based on, say, a primary residence, and you as a real estate investor buy it, and now that homestead exemption drops off and your tax bill goes up by 30%. So those things can happen too. And what happens is you've been putting money into your escrow account every month. Let's say you've got a $12,000 tax bill. You've been putting $1,000 a month in. The tax bill comes due, and now it's $15,000. So either you have to pay that $3,000 that you owe to the government for taxes, but sometimes that's hard to come up with $3,000. Or the servicer can say, well, now we're going to split the new yearly payment, the $15,000. We'll divide that by 12. And now we're going to divide the extra $3,000 over a certain number of months. And then so your payment's going to go up, and then it's going to come down to what the new level is when everything these escrow accounts. This is something that I think helps borrowers and home buyers feel a lot better, is that these are very strictly controlled accounts. They can't just stuff a bunch of money in there and hold on to it and earn interest on it. Sometimes when we set up a loan, we'll get a warning from the software saying, hey, you can't actually have that much in the escrow account. That violates whatever regulation.
Right.
So it's hard to get, if you see something weird, call us, talk to the lender that did the loan. If it just doesn't make any sense, call them. Sometimes they do make mistakes, but almost always it gets worked out the right way.
Got it. So just to recap, escrow account, when you're getting a mortgage, you can either escrow your property taxes and home insurance, and they'll just add that to your mortgage payment. And they try to guess which is what your insurance is actually going to be over the year, and then also what your taxes are going to be. And sometimes your taxes will go up and insurance go up, and then they ask, "Hey, you're escrowing this. We want to collect more money in escrow." Occasionally, I've had a property where they said, "Hey, we're collecting too much," like you just explained, and my payment went down a little bit. If you want to avoid that worry altogether, you don't have to escrow. And you could just say, "I'm going to pay my own insurance outside my mortgage payment. I want to pay my own property taxes outside my mortgage payment," and then your mortgage will be fixed forever.
But guess what?
What?
You get a slightly higher interest rate or a slightly higher closing cost if you make that choice.
Okay, because the bank says that's a little bit risky because I'm not controlling whether you're budgeting properly for your property
Or
taxes.
if those taxes don't get paid, or the insurance lapses one day and a tree falls on the house. I mean, you and I, Alan, we bought a house and we owned it for 2 weeks and a tree fell. We're like, glad we got insurance.
Yeah.
So that does add risk. Now, the reason that you can't even have the choice unless you have at least 20% down is that 20% are the golden handcuffs that's not going to let that person walk away from that house, even if a tree does fall on it when it doesn't have insurance, right?
Okay.
So anything, that's kind of the magic threshold. Nobody's going to walk away from 20%, right?
So So I didn't realize that it was one, non-optional for under 20%, and two, that if I declined it, it would increase the rates. But now that you explained it, that makes complete sense why,
And it's not crazy. It wouldn't be too noticeable. Most investors, for example, or somebody that's putting 30% down, if they have the option and they like to control everything, they will. If that fee is not going to change their mind.
I mean, I'll tell you this: like the houses that I've bought in all cash that don't have an escrow option because there's no mortgage lending. Like I hate that huge surprise property tax bill that hits me at the end of the year, and I'm like, oh man, it always catches me in a bad time. I am not budgeting for it each month, and I sort of love the escrow options on all my other properties because I just know it's out of sight, out of mind. My property tax bill is going to get paid. My insurance is going to be paid. It doesn't require me to schedule it, to write a check, to log onto a website, to move it's just take something off my mind. And it's okay if I'm paying an extra $20 a month into an escrow account, because it's not that $20 is wasted. It's held, right? And if there's overpayments, they will refund the money back to me. It's just held in an account that belongs to me. And when I sell the property, whatever that overage is, it comes back to me as well. So, but I understand you're lending out money at 0% interest to someone, like money sitting in an account doing nothing for you. But it is, I guess, giving you peace of mind, if not financially.
Typically in the grand scheme of things, I mean, a first-time home buyer usually doesn't have 20% down. So they're always going to have, not always, they're very likely going to have an escrow account. Now, that person also may not have a ton of other assets, right? But if you think about somebody that typically has the ability to avoid an escrow account, the amount of money that's sitting in that account interest-free is a very small part of their portfolio. Right. That forced savings plan just how much is the value that you could have earned on the interest on that? Or you would have earned like $3 in interest this year on that money.
Right.
But so I'm assuming that not having to worry about it is worth the $3 you would have had to pay, or you would have earned in interest.
Got it. Yeah, that makes sense. Quickly, thank you for everyone tuning in live and later. Please like and subscribe. Appreciate all your feedback and reviews. This show, as all my shows, are sponsored by Jasmine Mortgage Team, which is who I have today with Jeff Goddard, the branch manager at Jasmine Mortgage Team, who does their loans out of Waterstone Mortgage. Talk to me. What's recasting, and how does that sort of apply here post-closing and affecting maybe my payments?
Yeah, so if this comes up a lot when people are moving from one residence to another, and if they don't have to sell one prior to buying the other one, it makes their life a lot easier. It makes the realtor's life a lot easier too, because you don't have these back-to-back closings. or contingent offers or whatever. So if the person is able to carry both mortgages at the same time and have them overlap, go through underwriting knowing they can carry both, they're still agreeing to move into the new one if it's a primary within 60 days, things like that. But once they sell the other house, they might have another 100 grand they want to throw at the down payment. There's a lot of equity sitting out there right now. So I think we're going to see a lot more of this. So if they just took that 100 grand, say 2 months after closing, and applied it to their $500,000 mortgage, guess what happens to their payment?
What's that?
Nothing.
Okay.
They just made their 30-year loan like a 22-year loan or something, right?
Oh, I see what you're saying. So your monthly payment doesn't change when you.
That's just throwing it at principal. You just shorten the loan. You didn't lower your payment, right?
Yeah. Okay. Got it.
That same $100,000. This is just a rule of thumb. That same $100,000. If we were to let you put that in and then stretch the loan back out over the remaining term, not chop 8 years or something off the end, then your payment's going to go down, in this case, with $100,000 toward principal, probably by about $500 a month. And that's real money.
Yeah, right.
Now, the question is, what's the opportunity cost? What else could you have done with that money? Now, it could be that 100,000 got you lower than 80%, and maybe your PMI will then drop off.
Mm-hmm.
But so there are all kinds of things to consider, and we're glad to talk through any specific scenarios with anybody that wants to think it through.
Yeah. As a real estate investor, I would say take that $100,000, go buy a separate house. Don't pay down your mortgage, especially with interest rates so low. But everyone's situation is different, and comfort level and risk level. I understand that. But yeah, so so if you're making extra $5 payments on your mortgage payment each month, so it's a nice round number or whatnot, that does nothing but change, like you said.
It only affects you. Yeah. I mean, it does pay the mortgage balance down, but it doesn't lower your payment.
Right.
Yeah.
It shortens your loan a little bit.
Most people don't. Yeah. Most people don't keep a loan 30 years anyway. So
the difference between a recast and a refinance is a recast doesn't say we're resetting the clock and now the 30 years starts over. It's saying we're going to keep the terms that you have, but we're going to adjust the interest rate on and the balance. So your principal is $200,000. You put $100,000. Now we're going to do the interest rate times $100,000 instead of $200,000. A refinance is different in that it would reset the clock. You have a brand new mortgage starting at 30 years, and that would drag out the payments. Right.
The most important distinction between the two, because you could achieve the same thing with either one, kind of, depending on how we do it. The big distinction is, on average, you're going to have about $5,000 in closing costs. Now, they could get added onto your loan, but that's $5,000 fewer dollars in your pocket when you sell this property.
Right.
It won't affect your payment very much if you refi, especially at a lower interest rate or something. So the great thing about recasting is, one, it lowers the payment, not the term, and two, it's no cost.
Oh, yeah. Refinance, you're paying for a new mortgage, new appraisal, all that. Recast, it's just, hey, we're going to just change some numbers in a spreadsheet.
Now, I know that you're a kind of cheap, frugal guy, Alan. So I just want to make sure you know one caveat.
Okay.
You need to put a big chunk down for them to let you do that. Usually there's a minimum of like 10,000 or something. They're not going to do it for $50.
Right. Of course. That makes sense. Yeah.
And the other thing is, not every loan has this option. When Jasmine's locking a loan, if you think and we'll talk through this, and usually we can uncover if people want to do that, we have to make sure the investor that we're planning to sell that mortgage to is going to give us that option.
Okay. Right. Because you lock in the terms of the loan for 30 years, and you have to lock in the right terms so you can sell it to someone else later. And those terms matter, the value of the loan. And that's also my understanding that I think if your loan does have a recast option, which I think majority of them do, or at least close to 50 at least do, it's my understanding you can only do this maybe one time per loan. Is that right? Or
I think there's a certain window of time near the beginning that different investors will let you do it. There's a minimum that because there is work that goes into it. They don't want you to refinance,
Right.
And so they're going to spend a little effort to keep the loan so they can keep earning interest. But there is effort, so it needs to make a difference, and it needs to make a difference to I mean, really, $500 a month. I would rather. You got to throw a lot of money at a mortgage down payment to really move the needle on the payment.
Yeah, yeah.
And unless you've got that kind of money, it doesn't matter.
And I mean, another way is to buy down points, and what that means is basically, let's say you get quoted 3.25% interest rate, you can put down, sometimes it's, I'm just making up numbers, but 1% of the loan amount, to buy down the rate to a 3% or 2.2, put down 2%, 2 points. Points percents are interchangeable here, but the phrasing is points. Buy 2 points, which is 2% of the loan amount, to get an even lower rate.
And so when would you want to do that or not do that, Alan? You want me to answer that question?
Well, I have an answer. I want to hear your answers. Maybe we have different answers. I don't know.
All right, you go first.
I would never do that. Because I've done it, and I've done it with you guys, and every single time I learned, like, why did I do that?
We told you not to. You wouldn't listen.
I know, but it's so fun to just say, oh, Alan, you've got an option to spend $5,000 to bring this rate from 3 to 2.75, and you're like, yeah, I want a 2.75 rate. Like, who doesn't? And so then I'm like, yeah, I'm going to hold this property forever. But typically, if you do the math, whatever, I spend $5,000 to get that extra quarter, and it's like, oh, wait a minute, I have to. How much money did that save me? Maybe it saved me $9 on my payment, $10 or whatever it is. And you do the math. And then I'm like, oh, I have to hold this property for 7 years for it to make sense that this saving starts kicking in year 7 through year 30.
Well, the savings, now hear me out on this
Yeah.
one. The savings does start month number 1.
Right. Yeah.
Payback is not for maybe 7 years or however much the math works out to be. Right?
Yeah. Okay.
You haven't started actually saving because you're still paying back what you had to spend.
I paid extra up front to save money, and then it's like, when do I get to cover that upfront money? Right.
Yeah,
it's usually
payback period is important. And honestly, if people are like, yeah, this is my forever home, well, until your family member gets sick and you have to move and you didn't expect it. And so typically the smartest thing is to not just kind of hit that par rate where you're not getting money back, you're not paying money for it. And then, but based on how the pricing in the markets works every day, sometimes it can make sense to buy the rate down some, not like huge amounts, but it just depends. And every day, every hour is different. And when it comes time to lock, you should think through that.
Yeah. You run the numbers, make sure the math makes sense. But yeah, everyone thinks they're buying the forever home. Everyone does, and then they get married, or then they have an extra child, or they get divorced, they get a job transfer, or they, like you said, a sick relative they got to go live with. All these things happen over within 7 years, and that's, to me, whenever I did the math, it was like I have to hold it for 7 years, and I always coach and tell, put as little money as possible in every single deal. So if you're paying extra on points, you're going against that advice of putting as little money as possible in each deal. And then, people can play the game. Well, I'm putting more money in to save more money. And if it's an investment property, I'm saying, does it cash flow without points? Then don't pay points. If the only way you can make this cash flow is to buy points, I would say then do it. But 2, maybe this is not a good deal for you to buy if that's the only way to make the numbers work. Maybe you just love this property, or it's adjacent to your other property and you want to do some sort of assemblage, like you've got a bigger plan than just cash flowing off that one property. Then I can also argue for that. Like, okay, you don't want to buy a property that's losing you money each month, and if buying points is the only way to do it, then go for it. But you can also just put a bigger down payment, right? You, instead of putting 20% down, put 25% down. That'll probably adjust the numbers just like buying points.
Well, the funny thing is, on investment, I know a lot of your folks are investors. If you should glance at, when you're thinking about how to structure the loan with Jasmine, to at least look at what would happen to the rate if I put an extra 5% down. Because sometimes, especially on non-owner occupied stuff, it can make a huge difference.
Yeah, right. Because it's all, your interest rate is a risk rate to the person giving you money. They're sizing up your credit score. They're sizing up, are you going to live here? Is this going to be an investment property? Because if you have to abandon one of your mortgage payments, you're probably going to abandon your investment property before you abandon the house that you live in. Like, all these are different risk profiles. If you're putting down 3.5%, 5%, 15%, the person who puts more money down is less risky to the person giving you money. So just kind of understand that interest rate score is a little bit different for everyone, because it's based on how much income you make, how much you're putting in your down payment, what your credit score is. And so buying points and all this kind of throws into that factor. So kind of look at it on the other side of the table, the person giving you money, why they're giving you that rate.
And that's also the primary reason why people will ask me, why can't I use a Fannie Mae mortgage to flip this investment property that I want to flip? Should we chat about that for a second?
Please give the definition for those who don't know the Fannie Mae and Freddie Mac, what that is, the difference, and then yes, please.
So Fannie Mae and Freddie Mac are kind of like the mom and dad of the mortgage world. They're quasi-governmental organizations. They're organizations that they're not going to let fail. They back most of the mortgages in the US. There's a big movement to have more private backing of mortgages, but right now the volume is such that the private sector, I don't think, could handle it all. So they serve a very important role. And when the Fed starts doing things like quantitative easing, they're buying mortgage-backed securities from people like Fannie Mae and Freddie Mac. So they're directly influencing the housing market that way. And then what was the question we were trying to answer?
Sizing up,
Oh yeah, occupancy. Okay, yeah. So a big risk factor, especially for primary residence versus investment, is, are you going to sleep there every night? Because obviously that's the last one you're going to let go of in hard times. And so that's where you can get the 3% down and the great interest rate and all of that. Because if it's a primary, now if you say, well, no, it's going to be an investment property, and they say, well, that's 20% down, your interest rate's going to be a point higher, we'll probably start thinking, well, why don't I go talk to another lender and just tell them it's going to be a primary, and then I put 3% down and I have a much lower interest rate. That distinction, that's such a hard pull, because the numbers are so dramatically different, but that shows you how much the risk differs between primary residence and investment. It differs so much, you can see it, the risk level, you can see it in what you get quoted. The problem is that paper you sign at closing that says the FBI investigates mortgage fraud is specifically about this, a bunch of other things, but occupancy fraud is the biggest fraud in the mortgage world. So be very careful with that, because people watch for it all the time.
Yeah. And so let's talk about that. So if people get a owner occupancy loan and then they have no intention of moving in, and obviously you misrepresented the purpose of the loan, and that is fraudulent activity. However, if you buy something and you move into it, as long as you have, from my understanding, right, you could move out the next day and say, I lived there one day and then I got a job transfer. Like as long as you have a legit story to back up why, A, maybe you never moved in the property, or two, why you lived there for only a day. But as long as you have a story, then you're good. But typically, as long as you live there for a year, is my understanding, no one, and then move out, you don't even have to have a story. You just say,
the narrative really matters. So, and the narrative really matters in that situation. Usually when you're going to get the mortgage for the next house, because they're going to be saying, wow, you just got a primary residence mortgage 3 months ago. Why would we give you another one? Nobody moves in 3 months. And then you write your letter of explanation and all that kind of stuff. But the greatest way for, say, young investors to achieve this the old fashioned way is to buy a home, live in it, turn it into a rental, maybe get in with 3% down, and then go buy another house.
Yeah, 3.5% down payment, super low interest rate because it's owner occupied. And then when you move out, you don't have to call your mortgage company or lender and say, "Hey, I'm getting a new loan." Like you're now grandfathered in with that loan. You lived it, you checked all the boxes, and if you turn it into a rental, no one cares. Is that an accurate statement?
Yeah, and the thing is, the most important thing is that the payments keep getting made, right? And so that's all that really matters at that point. So the
Yeah, if you're making mortgage payments, no one's going to be knocking on your door asking, for ID. It's when you start missing mortgage payment, that's when everyone starts asking questions. Wait a minute, did you quit claim this to another company? You have rental insurance now. You don't have primary homeowner insurance. Like all those questions pop up once you start missing a mortgage
so
payment.
here's a couple of things to keep in mind to avoid anybody asking questions like this. Do everything you should do when you move into a house. Update your driver's license, change where your banking mail goes, do all that stuff that a primary residence holder would do. And then if anybody does ask questions, for example, you decide to move across the country and rent your house out and you just bought it as a primary. When after your closing, there are a lot of other closings that happen over the next few months as that loan moves through our economy. And people can Google an address and see if it's listed for rent, and it happens.
Right.
But if after a month after you buy a primary and you've got it listed on Craigslist, they're going to start asking questions. And you can say, I moved my family. Here's the moving receipt. I changed all my addresses. And here's the letter from the doctor about my mom who's sit down. And
right. Yeah.
And then you did what you were supposed to do and you had documents back it up.
And one of those questions might be, it's 2022. Why are you listing your house on Craigslist? That's
I'm lost in 1997.
Actually, I don't know. Some cities, maybe it's still a thing. And I guess New York, I think, still has it. And Craigslist as a place to list your apartments. Just messing with you. Here's another question for you. What's the cost of like waiting to buy? Is that the market is hot? Sellers sometimes or buyers will say, well, I'm going to wait for the market to change. Maybe I'll wait for the interest rates to come down because I know they've inched up a little bit. Do you have any advice for people maybe thinking those thoughts?
Yeah, don't do it for a couple of reasons. Now, obviously, I mean, you might know better than maybe I'm wrong on this, but all indications for me right now are rates. It's not that rates might go up. They've already started. And all indications are that they're going to continue to increase. The Fed is no longer doing the quantitative easing at the level they were, and they're signaling that they're going to keep tapering that, which means the bond market is going to lower and the rates are therefore going to higher. And pretty soon the Fed is going to make a bigger than usual federal funds rate increase. So all the rate stuff is moving that direction. And we still don't have any inventory and everybody still needs a place to live. There's no reason for prices to come down that I have seen yet. So if we looked, for example, I was just looking at this the other day. Last year in Atlanta, property values went up like 20%. Let's even scale that down. Let's say it was 10%. Okay. Yeah. So property values go up 10%. And then interest rates go up 1%, maybe from around 4 to around 5. So appreciation slows. You could kind of think it might with rates going up, but it's still there. And the interest rate goes up arbitrarily. Nobody knows, but let's say it's 1%. Your housing payment would increase by 30% for the same property.
Yeah, right. You might as well buy it now than wait a year and try to time it. I mean, my mom was stuck in this track. She's, looking for properties, and she's saved her, and she's like, okay, I saved up 20%. I want to put 20% down on a new occupant, homeowner, occupied up property. And she didn't like what she wants. So she's like, well, I'm going to save a little bit more and I'll get a nicer home next year, right? I'll have a bigger down payment. Now I can afford the next, price bracket up. And then what she found is like, after doing this 2, 3, 4 years, she was buying the exact same house because that house would go up to the next bracket as she saved up to it. And then it would go up to the next year to the next bracket. And she's like, I could never save enough to get ahead. If anything, the best case scenario, I could buy the same house 3 years later. It was just priced, 10% higher. And now I have the down payment for that house. But sometimes those houses are now out of her range because she waited. So I totally agree with you. Waiting to get a bigger down payment, waiting for prices to adjust or interest rates to adjust. You can't save enough. You're not going to beat the market that way.
Yeah. So a lot of people are still afraid of 2008.
Yes.
That affected a lot of people in horrible ways. And that was primarily driven by really bad underwriting. So we won't even go into all the details, too many people to talk about too much. But ever since then, the underwriting has been really solid, and the people getting mortgages today actually have jobs. Their income was actually looked at and verified. All of those things that were not happening in some cases back then. Not every loan back then wasn't bad, but a lot of people couldn't weather the storm of a drop in valuation. And if they couldn't sell it, they were underwater, then they would foreclose, and that just happened. Right now, we've got a ton of equity. If somebody loses their job right now, most likely they can just sell their house, take the 30 grand or whatever, go rent an apartment until they get a new job and go get a new house. They don't have to go into foreclosure.
Right.
So the only thing that I've heard that has concerned me a bit lately is the amount of corporate investment in residential real estate in America. If you see somebody like Zillow saying, we're getting out of buying homes altogether, that was hundreds of millions of dollars of kind of a homes that hit the market. I don't know what private equity funds are going to say, hey, we're out too. We made our 30% over the last 18 months and we're going to dump it. I don't think they would want to do anything that would impact their whole portfolio adversely. But those are some of the things that are a little bit different in the market now that weren't there then.
Yeah, I know. I think Zillow had like $3.4 billion of inventory. So imagine that hitting the market. Obviously, that would so much volume. It's all supply and demand. You way too much supply. So they are incrementally releasing some of those properties. Sell their other portfolio.
Over the next couple of years,
yeah,
1 in 7 homes sold.
Yeah.
Now, it seems typically every year 1 in 7 homes sells. Right? Now it's more like 7 to 10 years. But right now, if we had another increase in home selling, the inventory shortage is so great that I think we could pretty well absorb it.
Yeah. No, I think so too. And then, man, sorry, I lost my train of thought. Yeah, my other point, it was, if you live in a property for 7 years, the worst from 2008, the worst time to try to sell your home, 2009, it was the bottom of the market historically for housing. It took 7 years for all those houses to regain their value. So their peak from their peak at 2008, 2009 down to the nadir of the bottom market. It took 7 years for pretty much everybody to get back to what they bought at the most speculative time. So, if the average home ownership is 7 years and the worst recovery time we've ever experienced was 7 years to get back what you bought into, to me, it's always a good time to buy as well.
Yeah. And over those 7 years, your housing payment was fixed. You were still getting tax advantages of having a primary mortgage. There were benefits there. No landlord was raising your rents. Most of the time, property taxes were even going down. And just to break even on that, there are benefits.
Yeah. Yeah. And look at it this way. If you, so you broke even on your investment, right? Now, when do you break even on renting for 7 years? Like, there's no,
I don't think that date exists.
You will never break even investing or renting, but you will break even, if you bought at the worst time and just waited 7 years. So that's another way to kind of, push for buying houses over renting houses. So anything else you want to share that maybe people post-closing mortgages, things that they need to be concerned about?
I think that it's just important to know if you have a relationship with a lender, hopefully it's with Jasmine Mortgage Team. Anytime after closing, we talk to past clients all the time. Even if somebody else is collecting the check, stay in touch with the person that originated the mortgage, because they care. They want to maintain a relationship with you. They will help you look at strange things that come in the mail, or maybe some issue with the escrow account, and just give you a comfort level that things are the way they should be.
Yeah. And worth noting, if you don't like who you have your mortgage, or it's been sold, you don't like the servicing company, you can refinance with any bank. You don't have to refinance with the company that gave you that mortgage, or if your mortgage has been sold, you don't have to refinance with that company. And so if you're not happy with what you got, call, reach out to jasminemortgageteam.com or jasmineteam.com and just get the refinance options. You can do that. So a lot of people think they have to refinance with a company where they got it from or who currently is servicing it, and that is simply not true. Jeff Goddard, Jasmine Mortgage Team branch manager, thank you so much for joining us, explaining these sort of nuances. I learned a lot today. Maybe I will pay points on a mortgage again one day. But I like the recasting thing. I've never done a recast. I've looked into it. I think that a couple times where I wanted to recast.
Well, here is something, Alan.
Yeah.
You put $100,000. Now I know you didn't want to do it. You want to go buy another investment property.
Yeah, right.
If you put $100,000 toward the principal on a 3.5% mortgage, you just invested that $100,000 for a 3.5% return.
Right.
Could you do better? What's the opportunity cost? No, like you said, everybody's risk threshold is different. Maybe having a smaller mortgage just feels that much better.
Yeah. So you could buy another property or put it in stocks that would probably earn you 7-8% kind of thing. But then people just have this psychological like frozen paralysis that, I need to have my house paid off. I mean, if you're doing the house fire approach and you're just like, I just need to reduce $500 and that'll be my last bill paid off. I can burn my bill with lower payment on a rental property or something like that. I can see that. I try to use real estate as a tool. What are the problems you're trying to solve? And then let's create a plan for that. Is what the problem this is your last expense, or could you turn that $100,000 into 3 other properties that are earning you $800? And then all of a sudden you could have spent $100,000 to recast and say 500, but maybe we could deploy it somewhere else and you're earning $800 a month. And then, what are your goals? Do you want more income? Do you want to reduce your expenses? Combination of the two. And there's not one size fits all answer there, but that's why calling and talking to you and your team is great, because they're going to give you the tools and the options. And they're going to say, if you do this, if you want to do Y, then this is what you get. So it's really trying to figure out what problems you're trying to solve out there.
That's good advice.
Oh, well, thanks. Well, you gave some good advice here. Thanks for explaining all the different things, and thanks for always being, you're always welcome on the show. You're a great sponsor, and I love that. I personally use you, and that's how we met. You've done a tremendous amount of for me financially and providing loans for me. So I highly recommend anyone listening, if you're looking to refinance. I say this quite often, Jasmine Mortgage Team is where to start. So thank you, Jeff, and can't wait to have you back and dig a little bit more deeper into being the master of the boring stuff at the mortgage branch.
Thanks, Alan.